Hello again. Welcome to the closing bell video on the 2nd of October. Bit of a different format today because my video guy is away for the week. So I'll just be taking you through the charts. And this week we have seen a bit more selling. Hopefully, if you did see last week's closing bell video, I was discussing why I was still a bit nervous that there may be more to come on the downside. And I think at the time I was saying that we had already seen the start of some selling pressure, and this being the weekly chart of the E-mini S&P 500, pretty much the S&P 500 stock market. And even though the trend is definitely up, I was saying that we've got the weekly sell pivot in place, which was confirmed a few weeks ago. And then we got another week of selling. So I call that the first key bar in the move. Once prices on a weekly basis closed below the low of that weekly sell pivot candle. So that's just giving me the sense that the selling is starting to step down. And I did say to you at the time, when prices had bounced from the lows last week, and we saw this big spike to the upside and people started getting really bullish again, I was saying, look, watch out, because we could open the week strong and finish weak. And this is where the S&P futures are right now as I record this in the afternoon on Friday. And look, I don't know. I think prices could be miles away from there by the time you watch this. Because it has reached a point now where it is breaking down below last week's low and also through the 20-week simple moving average. So it's starting to look a little dangerous, where it could extend quite rapidly to the downside, or if the buying pressure comes in the overnight market, it could have the false break of that low and all of a sudden spike back to the upside again. So we're sort of at a point where the volatility will be quite high from here, and it's the overnight market. So it is that question of if it stays down here and weakens further, so that US markets are opening very weak below the low of that previous week, it could really have a big move to the downside. So I'll be interested to see actually what happens overnight, and you will know more than me what has actually happened. But I just wanted to point out that the situation was now at a point where we could actually see a pretty sharp correction. And you'll see that since the COVID crash, once that 10-week exponential went above that 20-week simple, that trend has been very strong and has gone on for a very long time, nearly a year and a half now, of prices just revisiting that 20-week moving average and finding good buying support, and really never threatening to bust down through that 20-week moving average. So we did see the bounce, but now we're seeing the selling down through that moving average. So there's a lot of support down there, and could be ultimately be a pretty quick trip down below there to buying pressure. But I just think we could see a bit of a stronger sell-off on the back of the fact that energy markets are looking so dodgy, and we are heading towards tapering, and this market really is just very overstretched in the short term. So if I just look at the daily chart quickly on that S&P 500, just to show you what I was saying in the article, that weekend article that this video was attached to, we've got the 100-day moving average. You can see there, the red one. And then the 200-day, this is the one that everyone looks at. And it really is quite similar to the 10-month that I look at. It's a fairly similar time frame. But that 200-day moving average is super important. If I just go back over the past few years trading in this S&P 500, and we have a look, you'll see if you follow that blue line Prices so often bouncing off that 200-day, finding support there for a long time. When it fails, it's a big sharp move. You then see a rally attempting to get above that 200-day, can't do it, another sharp sell-off, breaks above it there, and from that point forward, we basically held above that 200-day moving average all the way to this point here. And that is, a couple of years trading where you've got prices just retesting the 200-day on multiple occasions and finding support. Big rally, retest the 200-day again, retest again. And it's not until here that it actually breaks the 200-day. And, lots of volatility around the 200-day. And then finally, a really big sell-off. And, even this rally, you can see the same thing. There's the 200-day moving average. Prices break through to the upside, then find support at the 200-day over and over and over again. And then the COVID crash finally busted through the 200-day, and that's where you get that absolute smashing. So it really is an important moving average to watch. You can see we've busted back above it early in the recovery process here, and we've actually been holding above the 100-day, just showing how strong this trend is. But we're just breaking down through the 100-day now, so it should really go to retest that 200-day moving average around 41.30. And it could be there now when you're watching this video, I don't know, or it's had a big bounce. Let's see what happens. But I think we will revisit the 200-day, and really the question is what happens there. Is it going to find the buying support? And I think in the short term you'd say yes, but I just think the risk is rising that we do actually see a bit of a move through that 200-day moving average. Which is why I've sort of been saying for weeks now that just lightening exposure now that the weekly sell pivot was in place wasn't a bad idea, because you don't really want to be scrambling out of positions if that breaks. You'd prefer to be taking some profits up here, which is where I've been saying watch out, so that you're not having to do too much when the market's trying to decide what to do around that very important level, because you could see lots of volatility, but it could ultimately hold and turn back up, and then you could re-enter positions. You don't really want to be not doing anything, buying through here, not doing anything, waiting for it to crack and look terrible, and then you're scrambling out of your positions, and then the market might just base there and turn back up, and then you're kicking yourself. So that's one of the reasons why I've been sort of saying, taking a bit of money off the table before it turns really pear-shaped is usually the best policy. So just quickly on the ASX 200, I just wanted to point out those old all-time highs. This is the all-time high before the COVID crash, which you can see there, and that's the old all-time high from 2007. And just wanted you to notice how prices move, the way that you can see this spike up through the old all-time high, and then the false break, and then that was the beginning of the COVID crash. So I'm just always wary of these false breaks when prices can bust up through an old level, get everyone bullish, take out all the shorts, and then if the false break occurs, you can just see a bit of a mean reversion event, which I've been discussing for a while, and that could be back towards that 20-month simple moving average, and then from there, who knows, could bounce, look fantastic, or really get ugly. But just the point being, we've been rallying for a long time, we've just broken out to new all-time highs. There's just a risk of this false break occurring, which could see a bit of a clear out of positions. So that's why I'm just a bit wary of where our stock market is too. And very quickly on other key markets, the US dollar, we have looked at this one before. This has been stuck in a range for 5 years. As you can see, lots of false breaks of either edge of the range. I've discussed this before. And we had this huge wave down in 2017, 2018. And I've got the buy and sell zones in there. You can see where we've seen reversals back to that point of control. And then this is sort of shaping up I was bullish on that US dollar and then sort of backed off when there was a bit of recent weakness, but it's turned back up again, broken out to new highs in the move. So there's still a chance we're going to see a bit of a run in that US dollar towards that point of control, around 96, so currently around 94. But the long-term trend in the US dollar down, but it is starting to look pretty strong, and that can affect other markets, of course. Usually you'd think gold would be going down on the back of that, but it's actually bounced quite nicely, gold, which is interesting. I think it's still early days. I've been bearish on gold. The quick view of gold, very clear correction in prices over this last year. And yeah, my line in the sand, based on that low around 1680, prices actually need to bust down through there to look really terrible. And busting out above that sort of 1920 region to 1940 region, then I'd really turn much more bullish. So it's just a bit early days for me to change my tune on being a bit negative on gold, even though we've seen a bit of buying pressure out of here. So gold still needs to do quite a bit of work to look like it's turning back up. But other commodities are starting to feel the heat from this strong US dollar. Copper is the one that is starting to look a little bit soggy. We've got all these problems in China in their property market, and that could spell the peak of the commodity cycle for now. And I've shown you this in the past, this copper price going to revisit old highs, creating the false break, which is the beginning of the end, usually, in the past. You can see there, taking out the old high from 2008, and then failing to carry on with it and selling off for quite a long time. In this last rally, look, it's been a massive spike, and perhaps the long-term view on copper is still very positive, but we're just getting a sense of this false break of that high taking shape. So that just makes it feel like we need a bit more of a correction in copper before it will find buying pressure again or decide what it wants to do. But it just feels like for now copper is not going to keep rallying at the pace that it has been. Nickel is a similar story. I really was thinking it could actually break out. It's obviously been doing the same sort of thing as copper, where it creates a new high, sucks everyone in, and then the false break. And here again, that happened for the last few months since the start of the year. And I was hoping this one could actually extend to the upside, but I think all this China issues is just starting to affect markets out there. And you can see that prices couldn't hold above that high for very long, and we're seeing a mean reversion event in nickel, the heat coming out of the market there. So that's just looking a bit soggier for the short term as well, and a few of the other commodities looking like that. So that's just a bit of a sense that that US dollar now starting to affect things, and also who knows what's happening in China. Perhaps there's a bit of a flight to safety going on in that US dollar, and with equities starting to look pretty dangerous really right here, just for the short term. So maybe that US dollar is going to extend further to the upside. But US bonds starting to catch a bid after having a bad week, so that may help to stabilise things a bit. But really huge spike in gas prices is continuing. That's the Asian LNG prices. That is going to feed into other energy markets, and it's just a sign of, I think, things to come, and affecting a lot of businesses out there. Energy being just so important. What's going to happen in this winter with China, Europe, Asia, all fighting over energy supplies? How affected will businesses be? Will businesses have to shut down? What will happen to inflation? It's just a lot of things can come out of this, and it just feels like things will probably get worse before they get better. So that's it today for the closing bell. I will come back with more next week. Cheers.